en stocks y, por supuesto, seguimos poniendo la mirada sobre la última decisión de tipos que ha adoptado el Banco Central Europeo. También hablaremos de la Reserva Federal. Ninguno se ha salido del guión ya esperado por los mercados, ya descontado, que era pues esa subida en 50 puntos básicos. A uno y otro lado del charco hemos tenido la misma magnitud de incremento en los tipos de interés, pero hay cosas que nos llaman la atención. Por ejemplo, en el caso del Banco Central Europeo, que ya comenzamos a hablar de una reducción del balance. Vamos a analizar las principales claves con Kevin Thozet, es miembro del Comité de Inversión en Carmignac. Kevin, thank you so much for having us a few minutes in Negocios TV.
Hello. Hi.
Kevin, starting with the ECB, there have been no changes to the ECB script. It's been 50 basis points hike, and Lagarde insists that she will continue raising rates in the next meetings, at least in the three next monetary policy meetings. What would you highlight from Lagarde's message?
Well, I think that Mrs. Lagarde's message was very, very strong today. We had the Federal Reserve meeting earlier this week, which Mr. Powell managed to organize, I would say, a non-event. I think that Mrs. Lagarde organized a very significant event. We saw, for instance, the German two-year yields climbing as high as 30 basis points during the press conference. This has been unseen territories. So I think there's several lessons to be learned or to take out from today's meeting. The first one is that we are seeing a 50 basis points hike. This was largely anticipated, but what was not anticipated is that we will get very soon to this 3% terminal rate. Potentially within 3 months, deposit rates at the ECB will be at 3%, and that's the minimum. She also hinted towards the fact that they can go much higher than this. So that's I'd say, the first lesson. The second lesson is that inflation expectations at the ECB is much higher than what markets are pricing. The ECB is expecting inflation to be at 6.3% in 2023, 3.4% in 2024, and to still be above the 2% target in 2025. And again, it's much higher than what markets are anticipating. We also had some elements in terms of what will be happening with the balance sheet and the winding down of the balance sheet, and this is also, I'd say, raising some eyebrows, to say the least. We know that the ECB will be buying 15 billion of euros less to begin with, but this at a time where, in fact, in January and February, we will see massive issuances by sovereigns. Something along the lines of 100 billion per month. So I think that Mrs. Lagarde has been very, very serious on the fighting of inflation. Market reaction seems to say that it's whatever it takes. I would tend to disagree on this, and this kind of sell-off we are seeing today is showing some opportunities, and notably in so-called peripheral debt.
You mentioned this, whatever it takes, that we remember from Mario Draghi. Meanwhile, we have doubts about what the impact will be about the balance sheet reduction. De Guindos admitted a few weeks ago that the ECB was unaware of the consequences of starting with this reduction because it lacks of previous experience. Today, De Guindos has also avoided talking about that impact. He has recognized that they must be very cautious. What's your opinion about it?
Yes, well, as I mentioned, there's this kind of dichotomy between the willingness of the European Central Bank to wind down its balance sheet, first by about 15 billion of euros as from the first quarter of 2023. We will have more details about this quantitative tightening program and how they will wind down the program. And as I mentioned, there's very significant issuance in the face of this. What we think of this is that there's been a very significant sell-off in so-called peripheral debt, and notably on Italian spreads, on Italian yields, and they are above 4% on 10 years maturities. we would tend to see this as a buying opportunity, in fact. Why that is? Because obviously it's a high carry for 4%, but if we try to look forward of what might be happening, if the European Central Bank is indeed serious in terms of reduction in its balance sheet, then she will have to keep, I would say, peripheral spreads in check. So that's why I'm saying that Mrs. Lagarde is very serious about fighting inflation, but it's not a whatever it takes movement, because financial stability is very, very important for the ECB.
And Lagarde has also insisted that the ECB expects a short and shallow recession in 2023. What do you think about? Is it too optimistic or realistic?
We would tend to agree. I mean, the European Central Bank, or the European economy, is indeed already in, I'd say, a shallow recession. Why that is? Well, because we have, thanks to, I'd say, relatively mild weather so far, avoided the risk of disorderly rationing, because industrial production is holding well. I'd say, manufacturing sector has managed to reduce its gas bill, reduce its gas consumption, and without too much or too negatively impacting its production capabilities, so I would tend to agree with Mrs. Lagarde on the shallow recession we are in. Where I would tend to disagree, or have I'd say more of a cautious approach, is when she's talking about significant recovery. We believe that we will have more of a shallow recovery in 2023. So shallow recession, but shallow recovery, again, because the situation on the gas front is still not resolved, is still not solved. The global economy slowing down will also weigh, and as are higher rates and tighter financial conditions.
Kevin, if we go to the US, yesterday Powell also insisted on the need to continue raising interest rates. He announced a new rise of 50 basis points, as the ECB did today, and tried to calm possible stock market euphoria, we could say. What would you highlight from its principal message?
Well, Mr. Powell, just like Mrs. Lagarde, rose interest rates by 50 basis points, but I think it was a very different meeting and a very different hiking movements. Indeed, Mr. Powell managed to organize, I would say, some form of non-event. He's buying himself some time, and he's buying some time for the Federal Reserve. Why that is? Because what we have seen over the past month is that we have seen soft data, so consumer sentiment, PMIs, those type of kind of leading indicators falling south and being very much downward oriented. While at the same time, we have seen hard data, so inflation, jobs markets, retail sales, less so today, but anyway, over the past period, holding relatively well. And hence, Mr. Powell is buying himself some time to see how much of an impact has had the past 12 months of very aggressive monetary policy, what impact this will have on the US economy. So that's one important factor. I think that when I'm looking at market reaction in the aftermath of the Fed meeting and this morning prior to the ECB, well, in fact, markets don't seem to really believe the Federal Reserve. They're assuming that Mr. Powell got it wrong in the rising cycle and the rising inflation cycle, and that likewise he will get it wrong on the downside as well. So again, going forward, while as we mentioned, in terms of monetary policy, the European Central Bank raising rates by 50 basis points for several meetings down the road seems to be quite integrated and quite well guided by the European Central Bank. I think that the next meeting for the Fed, whether we get 50 basis points or 25 basis points, which will be very much dependent on the future inflation prints, which we will get on the 12th of January of 2023.
Jerome Powell also spoke of recession, but he didn't want to confirm it. He still confirms the possibility of a soft landing. Is it still possible?
Well, we think that what we will see, or what we will have over the coming months, is probably some form of illusion of a soft landing. We know that Mr. Powell obviously will try to engineer one, but in fact, soft landing of an economy is something which is very difficult to engineer indeed, and we think that investors should be prepared. So that will be further down the road over the second half of 2023. They should brace themselves for the risk of a harder landing, even more so if Mr. Powell is serious about bringing inflation back at 2%.
Turning briefly into China, we talk about two recessions, consumer and housing. Do you think is a double policy pivot coming about zero COVID policy, housing bailout, or some simple fine-tuning?
Yes, we definitely think it's the case. I'd say the road towards zero COVID, well, towards exiting the zero COVID policy will take time. And the reopening of the Chinese economy will not be like the reopening of the European one. It won't be all one way. It will likely take time, but Chinese authorities are hinting and are preparing the exit from zero COVID policy. And there are, I'd say, lesser tight measures in terms of mobility restrictions. They're also increasing the number of intensive care unit beds. They're also increasing in terms of vaccination, and notably of most fragile people. So they're, again, inflecting on that front and preparing to exit from this zero COVID policy. Likewise, on the real estate sector, we have seen several measures so as to help or support the real estate sector, likely not going to reflate the real estate bubble that Chinese authorities have managed to deflate over the past 12 and 18 months at a very high cost. But again, they're providing some form of support measures, lowering rates on the mortgages, for instance, allowing some developers to raise capital as well. And we think that this is a very interesting setup, because in this kind of a global recession environment in which we are moving into 2023, well, what's happening in China will likely be very, very different. And while we can discuss and argue about whether we will have a soft landing or hard landing in the US, whether in Europe the recession will be shallow or more severe, I think that one element which is very important and on which we collectively should agree is that China next year will be the only economic bloc where, in fact, GDP growth will be higher in 2023 than it was in 2022.
Thank you so much, Kevin Thozet, member of the Investment Committee at Carmignac. Pleasure.
Thank you.
Bueno, interesante lo que nos estaba diciendo Kevin Thozet en estos momentos sobre China.